Morning, everyone, and thank you very much for joining me. This is the morning market review. It's Thursday, it's the 13th of October. My name is Russell. I'm a senior market specialist at FXCM. My email address, archer@fxcm.com. And I'm just going to bring up our disclaimers, and we'll start off with the high risk investment warning. I'll keep this on screen for a few moments. I think it's Zanetta. Good morning to you. Nice to have you on the webinar. Thank you very much for joining. Thank you, everyone, for signing in. I actually overslept this morning, so I've just been in panic mode trying to get ready. I've got an exam bearing down on me, and it's been very disrupted in terms of prep. So I'm playing catch up. I think my body just gave in this morning. So it's been a stressful start to the day. All right, here's our market commentaries disclaimer. And here's our references. All right, let's start off with the Bloomberg email. 5 things to start your day. I'll keep the real rate on screen in the meantime. The first headline reads "Pointing Finger." So just before I read that, just want to double check. You guys can hear me and see the screen, right? Just want to double check. I'm quite paranoid about that these days. Just let me know if. Okay, cool. Thanks. All right. So the first headline reads "Pointing Finger." Chancellor of the Exchequer, Kwasi Kwarteng, and the British government are preparing to make Bank of England Chief Andrew Bailey a scapegoat if UK markets suffer renewed volatility after the bank's bond buying program ends on Friday. Speaking on the sidelines of the International Monetary Fund's annual meeting in Washington, Kwarteng told Sky News that any turmoil of the central bank after the central bank withdraws support is a matter for the governor. The moves by UK pension funds to dump assets to meet margin calls have contributed to selling pressure in recent days, and the reverberations are being felt everywhere from Sydney to Frankfurt and to New York. So there's actually, I think, a lot to be said in that article. I'm not sure of your views. First of all, what pension funds are doing holding margin that they are going to be margin called, I think is of in itself an interesting discussion. No doubt Andrew Bailey really riled markets with a completely unnecessary, harsh comment, not yesterday, but the evening before, when he really just reinforced that the Bank of England is going to be withdrawing their support for the UK gilt market on Friday as planned. I don't think that was necessary. It basically undid everything that the Bank of England was trying to do. I mean, it's odd. And I guess the kindest thing to say, it was a schoolboy error. Okay. So we can say that Kwarteng over here, I think, is out of line. This whole debacle was catalyzed by his mini budget. So he made a schoolboy error. He didn't consult Office for Budget Responsibility, which one would think is just something that is automatically done for these type of things. I think the fiscal policy opted for by Liz Truss is a schoolgirl error, right? She's trying to increase spending by cutting funding, which, you know, everybody wants to pay less tax. So If anything, one would think it's some sort of move for political gain. I don't know. When I spoke to my dad about it, he says, "But I would love to pay less tax." I said, "We're not talking microeconomics here. We're talking macroeconomics here. That's not the way it's done. If you're running a business, you know, the first thing that an analyst is looking for is cash and funding and debt to equity and all these kind of things. And if it's, if there is something that is not looking good, it's pretty obvious. Well, cutting funding, pretty obvious. So this whole thing's a debacle. Going on to the next headline, inflation priority. Treasury Secretary Janet Yellen said that while there's a collective need to shore up the global economic outlook, the path forward begins with addressing domestic challenges. In the United States, our top economic priority is to bring down inflation while maintaining a strong labor market. Yellen said, investors are currently on tenterhooks as they await US consumer price figures later Thursday. That's the big one. CPI today, 230. We spoke about it yesterday in the crypto minute. Very important data point today. This may determine if the Federal Reserve would deliver a fourth straight outsized hike in interest rates. Minutes from the Fed September meeting show that the officials are committed to raising interest rates to a restrictive level in the near term and holding them to curb inflation. They have to do this, by the way. So now we also spoke in yesterday's webinar how Cathy Wood, and it's not just Cathy Wood in fairness, there are now calls for, there's even calls out of the UN, believe it or not, for the central banks to stop raising interest rates. And to be quite frank, there is a risk that the Fed overshoots, but there is also an obvious misunderstanding of economics for anyone that is calling for the Fed to stop cutting rates. I think you can see that I woke up a little late today. I'm a little grumpy, but they can't stop now, and I'll show you why in a moment. Russia oil cap. Some Biden administration officials are growing concerned that their plan to cap the price of oil purchased from Russia may backfire after the OPEC Plus alliance surprise production cut last week. The plan seeks to keep enough Russian supplies on the global market to stave off a spike in worldwide oil prices, but the proposal has been the subject of intense diplomacy with European allies. The Biden administration is also considering a complete ban on Russian aluminium, long shielded from sanctions due to its importance in everything from automobiles and skyscrapers to iPhones. ECB rate. The European Central Bank can get close to its neutral level of interest rate by the end of the year if it hikes by a total of 125 basis points at its next two meetings, according to Governor Council member Robert Holzman. After increasing borrowing costs by 75 basis points on October 27, another 75, then perhaps in December, and even 50, we would be close where the neutral rate should be, the Austrian Central Bank chief told CNBC in Washington on Wednesday. The level would mean that monetary policy neither constricts nor stimulates, and would then allow the ECB to think about unwinding its bond holdings, Holzman said, adding that a possible mild recession in the euro area won't derail the ECB's tightening plans. Angry motorists. I saw a video of this on Twitter, and it was quite alarming. French motorists faced long lines at service stations across the country as a government threat to break blockades at some of the biggest fuel depots did little to end week-long refinery strikes over pay. In the latest effort to end the deadlock, French energy giant Total Energies agreed to meet with labour unions on Wednesday including the CGT, relenting on a previous stance that the union halted its walkout that is affecting many of the country's refineries. The walkouts have left almost a third of the country's gas stations with supply shortfalls as the CGT union spearheads a demand for higher wages amid soaring inflation. For French people, the crisis has hard hit, coming on top of higher prices for food and other staples. Coming up for this session, European equity futures nudged lower ahead of the highly anticipated US inflation figures. The last major data release before Fed officials meet next month. I'm going to read that again. European equity futures nudged lower ahead of highly anticipated US inflation figures. The last major data release before Fed officials meet next month. Germany, Ireland, Portugal, and Sweden also deliver CPI prints. G20 finance ministers and central bankers meet in Washington. Italy's newly elected parliament convenes for the first time. All right, so CPI today is very important. If we are going to get any sort of moderation, okay, in the core CPI, that's a first step before the central banks are going to stop cutting. And more important than anything is a moderation in the median inflation, and we've looked at that. But inflation has a very insidious effect on companies when it gets out of control, and the Fed knows this. The individuals calling for a stop in interest rate hikes perhaps don't know this. So I just want to run through this very quickly. We have looked at it before, but it really comes down to margins. So you've got sales is your top line. We're going to just say $100. To make those sales, there's costs. So we call those costs of sales. We're going to put that as 50. 100 minus 50 gives you a gross profit of $50. Okay. What we call gross margin, you take, sorry, that it should be a dollar sign. Okay. What you do to get your gross margin is you take your gross profit 50, you divide that by your sales, and this is a very healthy 50% gross margin. Right. Now, what we're going to do is we're going to assume that to make the sales of 100, there were 100 units sold at $1. That means that the 100 units were each bought at 50 cents. Okay. Now we're going to say that you go to your supplier who's supplying your inventory. The supplier says, apologies, inflation, we're upping our prices by $5. So we're going to charge you 55, not 50. So now let's assume this company, this hypothetical company, has huge pricing power, which is not always the case. But what is definitely not the case is that a company would be able to pass the full $5 on to customers. That they could pass some of it, and if they have a lot of pricing power, like maybe most of it, but to really get 100% of that inflation is highly unlikely. But for our example, we're going to just assume a best case scenario here. We're going to say that this company says, fine, I'm going to pay you your 55. I'm going to pay that I'm going to ship that full $5 increase onto my customers. So now my sales is going to be 105. Okay. My costs are going to be 55. So easy to see. What's your gross profit going to be there? Gross profit's going to be constant. Okay. Gross profit's going to be 50. I'm just going to put a dollar sign in here just so we can see. So it all looks like this company has done remarkably well, but it hasn't. Okay, through no fault of its own. It's through the fault of inflation. If you go and you now take 50, okay, divided by 105. So remember, we go to our first one. Our first example was 50 over 100. We got the 100 from sales. That 50 is the gross profit. Same here, we're taking gross profit of 50, but this time the denominator is 105, right? So you can just then run this through your calculator, and you're actually going to get a gross margin of 47.6%. In other words, although your gross profit is the same, your margins have been hit. As a company, we're less profitable straight away because of inflation. There's been no other influence except for inflation. Okay, you've managed to pass your costs on. So now, this is what is on the this is your first margin number. Now, how would a company respond to this? So gross margins, pretty much. I mean, you can look for other suppliers. You can try and manage your gross margins. A large element of gross margins would be out of management's control, but your next level of margins are completely within manager's control. And that here is going to be what we call your operating margin. So that's the next level in the income statement. We're not going to do any math here. Operating margin. Okay. Here you can actually come out. So let's just say your operating margin here was 30%. You can, through management, aim to get it 30% on your operating side. So your gross margins may be off, but you can start doing internal management to make sure your operating margins are going to be consistent. Well, the easiest way to do that is to cut costs. Okay, and the easiest cost to cut would be your variable costs. You'll start cutting down on your variable costs. So the first guys to go would probably be any temporary staff. You'll cut them and you'll just give their duty onto more permanent staff. And this could get really insidious if you don't get that inflation under control. If it spirals out and the cost cutting goes on, that's a serious macroeconomic problem, and that's what the Fed understands. Okay, so until we get that median inflation starting to roll over, forget about it. They're not stopping because business is affected. They're not just doing this because they feel they have to do it. They have to. Their mandate is price stability for a very good reason. It is a key driver of ordered markets, right? So that's what they're doing. Okay, so they're not stopping until that happens. So just wanted to clear that up. All right. Let's see if we can get some opportunities. Let's bring up this chart. So this is an interesting chart. So we've looked at this previously. This is oil, and we did get an oil headline in that five things to start your day. And the idea here is, yes, we had a huge spike here. So this is the OPEC cut. Okay, so they cut by 2 million barrels last week, and you can see Brent responded. I think I calculated this as a 15% increase. I think I can't quite remember. I'm not going to run the numbers now, and I think I calculated the movement on West Texas. I think it's at around about 17%. So these are strong spikes. However, oil still remains in a downtrend, and this is determined by the peak and trough analysis. This is peak and trough analysis. Okay, so even though we've got this really remarkable reaction to the OPEC Plus announcement last week, the key the key driver in the oil markets is not production at the moment. It's still that demand destruction. And when I say demand destruction, effectively it means poorer economics. Okay, so less energy is being demanded because it's not needed, right? So this earnings season is going to be very interesting. Number one, the margins are going to be hit, definitely on the gross margin side. Definitely on the gross margin side. We'll have to see how the companies are handling the operating margins, and then the net margin right at the bottom, right? So that's the first thing. But now we're seeing, well, energy is related to the demand side of the economy. It's a, you know, let's just talk about a trucking company. If there is demand for goods to be moved from one location to the other, well, clearly there's going to be a fuel demand just from that trucking company, just so it can participate, you know, in the or deliver the growing orders. Well, I wonder, you know, just logistics, just the logistics sector here, you know, would be suggesting that, well, orders have dropped off markedly. So one thing to look at is inventory. Are inventories growing in this earnings season? In other words, you take a look at a sort of a supermarket chain or a sort of a huge sort of a Walmart or even sort of a more I can't remember what that company's called. You know, when you buy the furniture and you put it all together, it's that huge company. Lost my mind. I can't remember it. Our inventory's kind of building up, you know. So, well, if inventories are IKEA, that's it. Yeah, IKEA. So if inventories are building up, well, they're not making it sales. It means they're not ordering new stock. Okay. So now there's a hit. Inflation, sales, top line is going to be a very important metric to keep an eye on. And this oil chart here, I think, is quite clear in that, well, we're still in this demand destructive phase of the current cycle. So I wanted to just have a quick look at that. Let's take a look at this chart here. Right, let's go through to US dollar. All right, so you can see here the dollar is just absolutely rampaging, and it's fine. What I want to show you is last week's low. Okay, so there's the potential reference candle on the US dollar. Now we've got condition 2. We've got condition 2. We'll only know if we've got condition 3 at the close of trade this week, right? But this is going to depend very much on the CPI print. Okay, there is certainly scope for a dollar movement here if the inflation is still not moderating. We're not overbought here, and so this is something that is worth keeping an eye on, because it could be the next higher trough. Could be your next higher trough. Okay, so this would actually be question mark because we don't have all 3 conditions in. And then I haven't forgotten the real rate. Okay, I just wanted to do the dollar analysis first. You can see real rate here, very similar chart, isn't it? Now take a look at this over here. Again, so we've got 2 out of the 3 conditions. This is going to be very much determined by the core CPI today. So keep an eye on this, and if we get a condition 3, well, then this is actually a higher trough. And again, we've mentioned this yesterday. How do we interpret this? Higher trough lays a platform for the next impulse, and that makes a tremendous amount of sense until we see the inflation starting to moderate. But how does that tie in with the RSI? And I'm battling with this, to be honest, because I feel that the RSI does need to. I feel it does need to normalize. The only issue is, of course, the fact that I think it needs to normalize is irrelevant. The real rates are going to respond to inflation, and if there's a strong inflation number today, we're going to stay overbought here. So then the question is, well, when does this moderate? And I don't know the answer to that. We're going to have to watch this very, very carefully. My feeling is, and this is just unsubstantiated, but I don't think that the market will normalize it until after the FOMC on the 2nd of November. I think they wait for that communication to sort of be released. Then I think there might be some sort of opportunity to normalize. So I think that there is a serious case to be made here for normalization, but I think it, subject to correction, is perhaps a little premature to be looking for it to happen just yet. So it's a very tough chart. The last time we went overbought, it was a very easy read. Okay, last time we went overbought was this one actually was quite a difficult read, because this was okay. So we talk about a miscommunication out of the Bank of England. Well, this was actually a complete miscommunication coming out of the Fed. Okay, if you recall the July meeting when Jerome Powell really gave an incorrect sort of signal by saying that we're at neutral. He just took all the, just like Andrew Bailey's taken all the good work and just kind of thrown it out. Jerome Powell took all the good work at that stage, threw it out, and then they just doubled down, and we can see what's happened since then. But the excess in the RSI was pretty easy to deal with, regardless, because it was just a quick in, quick out. Second time, sort of quick above 80, quick down. Here now we're building up a froth here. How do we handle this? It's quite concerning actually, because I think it has to normalize. I don't want to bring Bitcoin in now because we've got a dedicated webinar for Bitcoin, but Bitcoin did spend 6 months overbought about a year and a half ago, right? I don't see that happening here, but I mean, it happens. All right. Let's go back down to this chart. All right, so we are in zone 1 for the US dollar. I think that the sticky components of inflation are still very much an issue. That's my feel. Again, we'll know after the CPI release. It may have started. The sticky components may have started responding. Then we'll have a different conversation tomorrow. But we have got a cross here. We have got a cross here. So we've got the bullish crosses, but we won't get the swing until we get into the momentum area, and we're not going to go into the momentum area before the CPI release. I don't expect, because I think the market is placing their bets now ahead of the. They're not going to bid into the announcement, or if they are bidding into the announcement, we're not building any sort of base in the 80. So without that maintenance of the 80 area, again, I would suggest the we don't have that magnitude. So we're just going to have to keep an eye on this. At the same time, if the US dollar is showing some signs of strength, we can go through to euro, and you can see euro showing signs of rolling over, right? But again, the rolling over here, I think, would be largely muted. I just don't see a big move before that CPI, unless there's some of the sort of market moving news before that. This is the day ahead of us, but I think once that CPI comes out, volatility is going to jump. Let's just take a quick look at DAX, and we'll finish off here. So I think DAX is actually in a similar boat, because if the inflation numbers do be to the upside, I think it's going to savage the risk markets. In other words, I think that any signs of continuing inflation pushes the DAX this way. The surprise to the downside supports, and it does look as if there is a part of the market that wants to buy in. It looks like we're going to get across here. It looks like we're going to get across on the stochastic, but I would suggest that the volatility is going to be muted before the CPI release. I think that everyone's sort of placing their bets beforehand. All right, I think we can wrap up here. So if there's any questions, let me know. We've got the fourth workshop for day trading. I'm looking forward to that. And then next week we're going to have Remy. I spoke to Remy yesterday, and he showed me some really good stuff that he's going to be preparing. So I'm looking forward to that. What does it mean being muted? I just think it's going to be sort of a low volatile day until we get the CPI out there. All right, guys, let us wrap up here. We shall speak a little later in the afternoon. Thanks, guys.